Hello and welcome to the first chapter in Accounting 410. So we're starting at the back of the book. I switched things up a little bit. We had with some colleagues from different institutions, and we thought putting consolidation at the end gives you a better piece of, and you can have a longer exam on it at the end. So we're starting with 12, then going in 11. So chapter 12, as you know, because you've all read through the notes, is accounting for not-for-profits and public sector. We're going to do a very small discussion on this. You can read about it yourself. So small discussion, you can just read about it. Now, with the preceding chapters, which you haven't done any, you're responsible for all the textbook material in this chapter. What these notes do, they're kind of workbook type notes, is highlight some of the theory and then go through exercises. So since you've already read this, I'm assuming you've read these, I'm going to go pretty light on the theory and do more about the examples. Now, before we get started, I did just now actually put up another document, chapter 12, that I'd failed to include in the notes. It's exhibits, 2 exhibits that I want you to look at. So they're in your textbook, so if you've got your textbook, you can just use that. You can use your online textbook, or you can go ahead and print those off. It's up to you. I've put them up there. So if you are printing them off, just hit pause and then come back when you've got them. Okay, so not-for-profit accounting, very different than accounting for for-profit businesses. So the biggest difference between a not-for-profit and a business is not that not-for-profits can't profits. So just called not-for-profits doesn't mean they can never have profits. They can make net income, put it away, save it for a building, do all that kind of stuff. Can't do is distribute the profits to members. So that's the difference. With a public business, sorry, I've got a frog in my throat. With a public business, you can distribute, of course, the earnings, the retained earnings, to shareholders as dividends. Or as a small business owner, a sole proprietorship, you can take the money out. With a not-for-profit, you can't. The other thing is, they call it not-for-profit because that is not the goal. So, Canadian Tire, they want to make a profit. That's their motive. What's a not-for-profit's motive? Like, there's all kinds. There's big ones, like the Food Bank, the United Way, different foundations, and they all go down to small. Your community league is a not-for-profit. If any of you have played on sports teams or have kids who are playing on sports teams, if they're associated with school, there's parent groups or sports groups. Those are not-for-profits. So they're all different sizes. There's small arts organizations, large arts organizations, they're all not-for-profits. So huge variety of not-for-profits. And their goal is to provide some kind of service. So, let's just put up here to remind you, goal, provide a service or goods, for example, bank, and can't distribute profits to members. Now, you'll notice as I go through these notes, I write some things down. Other things I just talk about. Just because I'm not writing it down doesn't mean it's not going to be mentioned in the text. But I'm asking you to get all that theoretical information. So feel free down the stuff that I don't. And yeah, we should get along great. Okay, so there are two main methods to accounting for not-for-profits. The restricted fund method and the deferral. And we'll be doing both. It is only recently that not-for-profits came under the CPAC handbook. Before, not-for-profits kind of did whatever they wanted. A lot of them have grants of some kind from government or quasi-governmental organizations, and those entities told those not-for-profits what they needed from them in terms of reporting. There might be a form they had to fill out or something every year, a statement. So, when you get asked to be on a not-for-profit board, and you will, as soon as people hear you're an accountant or going to be an accountant, they will be thrilled, because if there's a not-for-profit board that needs you, they'll tell you. So I've worked with not-for-profits both as a consultant and on their boards at different times, from small ones to larger ones. So it's very interesting to see the transition, especially for the smaller ones, to this new way of accounting. Usually there hasn't been a transition, and sometimes you'll get not-for-profit or books are a mess. So it's not mandated. They have audits. Audits have become much more expensive because as auditing standards have changed, as you know from auditing, in the past few years, it's become, there's more steps, more things you have to look at, which is great and is essential for those medium and larger type organizations. It's the smaller ones that those audit fees can be really kind of high for. So a lot of times they aren't audited, they go on their merry way with the same board that's been doing things for the last 15 years. So it's interesting. The thing I really like about nonprofits is you're helping, right? You're helping an organization you believe in and improving its reporting, making it clear to the board members or members of the not-for-profit. And it's really quite rewarding usually. So when people ask, of course, depending on workload, especially if you're in the middle of doing CPA, maybe say no, but always take a chance and try one sometime in your career. You'll find it's very rewarding. Okay, that was my little blurb for not-for-profits. So you can tell they're near and dear to my heart. Okay, so let's get right to material in the chapter. So you've read all of this stuff, who the users are. Part 3 of the handbook is where you'll find the rules. Here's some key items. Not-for-profits, 4 statements. Statement of operations, statement of revenue and expenses. So we're talking about our traditional income statement here. And a financial position or balance sheet and what they show. So current and non-current classification of assets and well, that's just the same as we're used to. Then there's net assets and endowments. Those are 2. Net assets take the place of shareholders' equity. And endowments are permanent donations. Only the interest or dividends is used. So, for example, MacEwan has endowments for scholarships. People will donate money. Say this is for a scholarship for, let's say it's an alumni from the business school, for a business student, $500 a year, and here's all the money, and you can't touch the principal. Only the dividends will be used. So some years, in a good year, they might give out 2 scholarships, sometimes they might give out 1, or whatever. Internally restricted, externally restricted net assets. Externally would be from the funders, or the donators, or the grant bodies. Internally restricted is by the board. So you might get a grant. Let's say you were a food bank. You might get a grant to set up computer systems and tracking systems for the food. Then that's the only thing you can use it for. You can't use it for operations. So if you ran out of food one week and you wanted to buy some to distribute, you can't use that money. Internally restricted, that's usually if the board has a plan, they want to maybe acquire some equipment, then they put a certain percent, and that would be internally restricted. Unrestricted net assets can be used for anything, and don't forget, net assets in shareholders' equity, it's just assets minus liability. And then there's net assets invested in capital assets. So they kind of break things down a little bit differently than we do for public companies. Now there's 3 options for reporting net assets invested in capital asset. Any questions like on why I have the little blanks for you to fill in so you'll know what they're doing. You can report them as a separate component. You can just moosh them, that's a real accounting term. It's not, but clump them all. And then disclose the amount in the capital assets separately, or just don't present or disclose separately. Now, of course, if you're working with a not-for-profit, your first year, depending on the state of the finances, if they're fairly okay, I always like to think when I go into an organization as a new employee, if I go on as a consultant, or if I go on as a board member for not-for-profit. I'll try and see the operating cycle first. So the first year before I make any big changes. With a consulting role, of course, I can't do that. Then I'm brought in for a specific purpose. I do try and look at a broader picture in case they're missing something. But it's always good to make sure you listen to the people working there first, see how they're operating, see how they're using with things to find the deficiencies, instead of just coming in and going, we're changing everything. Now, that's my fee. I know there are others that just go in and change whatever they want to change without waiting. But you'll figure out which you are, and I'm sure there's in between as well. Okay, then there's the statement of changes in net assets. This, like our statement of retained earnings. Remember, it's just what you have at the beginning, what's come in, what's gone out, what you have at the end. And then the statement of cash flow. And you can read this, the big thing, no section for OCI. So I want to go to that extra little handout I asked you to get, just to show you what it will look like. Because you are responsible for preparing these statements. Okay, I'm going to start with the first one, Exhibit 12.1, and this is from your text, so you can find it there, plus all the supporting info. I just want to highlight some things. This is restricted fund or fund accounting. And you can tell because there's more than one fund. So they've got a general fund, and I'm sorry this is so small, you guys, but I couldn't get the font any bigger without going over the page. That e-textbook isn't designed to be copied and pasted, which I can see their point, but sometimes it's a little frustrating. Okay, so we've got the general fund and the building fund, and then the total. So a restricted fund, and we'll go more into this, has more than one fund, and they have a total at the end. So we're going to put columns for each fund.